I want to talk to you about something that most people in the United States are not paying attention to. And the reason they're not paying attention to it is that it's happening in a country that feels distant, in a market that feels technical, through mechanisms that feel abstract. But I'm going to show you, as precisely as I can, why what is unfolding in Japan right now has a direct, measurable impact on your mortgage rate, your investment portfolio, and the purchasing power of every dollar you hold. This is not a prediction about some distant hypothetical future. The chain reaction has already begun. The question is not whether it reaches you. The question is how fast it moves and how large the impact becomes when it does. Let me take you through the architecture of this problem from the beginning, because to understand what is breaking, you first need to understand what was built and why it was built that way. How Japan built the most indebted economy in modern history. Japan's debt to GDP ratio currently sits somewhere between 220 and 260%, depending on the methodology used to calculate it. That is not a typo. For context, the United States sits at approximately 125%. Most economists begin expressing concern when any country approaches 90%, because at that threshold, the country owes more in a single year than its entire economy produces. Japan has been operating at more than twice that level for decades. To understand how they got there, you have to go back to the late 1980s. Japan in that era was experiencing one of the most spectacular asset bubbles in recorded economic history. Equity markets roughly doubled in value. Real estate prices in major urban centers nearly tripled. The country was flush with capital, credit was cheap and abundant, and the consensus, as it always is during a bubble, was that the conditions creating the growth were structural, not cyclical. They were not structural. In the early 1990s, the bubble collapsed with devastating force. Asset prices fell precipitously. Businesses that had borrowed heavily against inflated collateral suddenly found themselves insolvent. Banks that had extended credit against those same assets were left holding catastrophic losses. And the Japanese consumer, watching the value of everything they owned decline, did the rational thing. They stopped spending. This is the mechanism that produces deflation. When consumers expect prices to be lower in the future than they are today, the optimal strategy is to delay purchases. But when enough people delay purchases simultaneously, businesses can't generate revenue. When businesses can't generate revenue, they cut wages and headcount. When wages fall and employment contracts, consumers have even less reason and less ability to spend. The spiral feeds itself. Japan spent the better part of 2 decades in this deflationary trap. And the policy response, the only tool left available when the private sector refuses to spend, was government spending financed by debt. The government borrowed, then it borrowed more. The Bank of Japan, the country's central bank, kept interest rates at or near zero to make that borrowing as cheap as possible. At times, rates went negative, a condition essentially without precedent in modern economic history. And because rates were near zero, the cost of servicing that enormous debt was manageable. Japan owed a staggering amount of money, but the annual interest bill was almost nothing. That is how you sustain a 250% debt to GDP ratio without immediate collapse. You make the interest rate small enough that the carrying cost stays within budget. The Bank of Japan went even further. Through a program of quantitative easing, they began purchasing Japanese government bonds directly, injecting money into the financial system and simultaneously keeping bond yields suppressed. Today, the Bank of Japan holds approximately 50% of all outstanding Japanese government bonds. For the 10-year bond specifically, their ownership share approaches 90%. Let that figure register. The Central Bank of Japan effectively owns the entire Japanese government bond market. It is simultaneously the issuer and the primary buyer of the debt. That structure can only function in one specific set of conditions: low inflation and low interest rates. Those conditions are now changing. The inflation problem that changes everything. For the first time in a generation, Japan is experiencing meaningful inflation. Not the hyperinflation of a collapsing economy, but genuine, persistent price increases that are altering consumer behavior and forcing the Bank of Japan into an impossible position. The cause is a combination of global supply chain disruption, a significantly weaker yen reducing the purchasing power of imports, and decades of suppressed domestic prices finally finding equilibrium. The result is that ordinary Japanese consumers are paying more for everyday goods than they have in their lifetimes, something that sounds mundane but represents a profound structural shift in an economy that spent 30 years dealing with the opposite problem. This creates a trap with no clean exit. Option 1, the Bank of Japan raises interest rates to combat inflation. This is the standard central bank response. Make borrowing more expensive, reduce demand, bring prices down. The problem is that Japan's government debt is now so large that even a modest increase in interest rates produces an enormous increase in annual debt service costs. At current debt levels, each percentage point of rate increase adds tens of billions of dollars to Japan's annual interest bill. The government's fiscal space, its ability to fund social programs, infrastructure, and basic services, gets consumed by debt payments. Option 2, the Bank of Japan keeps rates low to protect the fiscal position. This allows inflation to run, which erodes the real value of savings, destabilizes the yen, and ultimately destroys the confidence of both domestic and international investors in Japanese financial instruments. There is no version of this that is painless. The 30-year era of low rates and managed deflation bought Japan time, but it did not solve the underlying structural imbalance. It deferred it, and the bill is now arriving. The yen carry trade and why its unwind matters to you directly. Now I want to explain the specific mechanism through which Japan's internal financial crisis transmits directly into US markets, because this is the part that most coverage gets wrong or oversimplifies. For years, while Japanese interest rates were near zero, institutional investors, pension funds, insurance companies, large banks discovered a highly profitable arbitrage opportunity. They could borrow yen from the Bank of Japan at essentially zero cost, convert those yen into US dollars, and deploy that capital into US Treasury bonds or US equities, yielding 4 to 5% annually. The spread between the cost of borrowing and the yield on the investment was pure profit, with minimal risk as long as currency exchange rates remained stable and Japanese rates remained low. Here is the arithmetic at institutional scale. A pension fund borrows the equivalent of $1 billion in yen at 0.1% interest. It converts to dollars and purchases US Treasury bonds yielding 4.5%. The annual return on that position is 4.4%, $44 million per year, without deploying any of the fund's own capital. This is the yen carry trade, and it has been one of the most widely utilized strategies in global institutional finance for the better part of 2 decades. The scale of this carry trade is reflected in Japan's position as the single largest foreign holder of US Treasury debt, approximately $1.1 to $1.2 trillion as of the most recent data. That capital did not accumulate because Japanese institutions have a particular affinity for American government bonds. It accumulated because the interest rate differential made the trade extraordinarily profitable. Now the differential is collapsing. The Japanese 10-year bond yield has moved from near zero to approximately 2.1 to 2.2%. The 30-year yield has moved to 3.3% and briefly approached 4% in recent weeks, the highest level in more than 2 decades. When you account for currency hedging costs, transaction fees, and the operational complexity of maintaining a cross-currency position, the carry trade is no longer meaningfully profitable. For many institutions, it is now negative carry, meaning they lose money on the trade rather than making it. The rational response is to unwind. Unwinding the carry trade means selling US Treasury bonds, converting the proceeds back into yen, and paying down the original yen-denominated loans. Executed gradually, this is a manageable process, but the scale of accumulated positions is enormous. And when large institutional holders begin selling simultaneously, not out of panic but simply out of economic rationality, the effect on US Treasury markets is significant. We have already seen this begin. In April 2025, Japanese institutional investors sold more than $20 billion in foreign bonds over a period of weeks. That selling contributed directly to the volatility in US equity and fixed income markets during that period. That was not the full unwind, it was the early signal. What this means for your wallet. I want to be direct about the transmission mechanism from Japanese bond yields to your personal financial situation because the connection is real and quantifiable. Mortgage rates. US mortgage rates are priced relative to US Treasury yields. When Treasury yields rise, which happens when large holders like Japan sell their Treasury positions, driving prices down and yields up, mortgage rates follow. A 1 percentage point increase in mortgage rates on a $400,000 home loan adds approximately $250 per month to the monthly payment. Over a 30-year loan term, that is more than $90,000 in additional interest paid. This is not a macroeconomic abstraction. It is a direct cost to anyone who owns or is trying to buy a home in the United States. Equity valuations. Rising interest rates affect how investors value stocks. The dominant valuation methodology for most large US companies involves discounting projected future earnings back to their present value using a risk-free rate, typically the 10-year Treasury yield, as the discount rate. When that rate rises, future earnings are worth less in present value terms. This means that even a company with strong fundamentals and growing profits can see its stock price fall simply because the rate at which its future earnings are discounted has increased. This is not speculation. It is the basic mathematics of valuation. Government fiscal capacity. The US government currently carries debt at approximately 125% of GDP. As interest rates rise, the cost of servicing that debt increases. Every additional dollar that goes to interest payments is a dollar unavailable for defense, infrastructure, health programs, or anything else the government funds. The fiscal space of the United States government, its capacity to respond to a recession, a crisis, or a major spending need, narrows as rates rise. Two compounding factors that make this worse. The Japan situation is already structurally complex, but there are two additional forces making it worse, and both are largely beyond the control of any single institution or government. The first is demographic. Japan's working-age population, those between 15 and 64, now represents approximately 59% of total population, below the global average, and declining. Japan's total population peaked at approximately 128 million in 2010 and has since contracted to under 122 million. Projections extend this trend significantly through the end of the century. Last year, Japan recorded fewer than 687,000 births, the lowest annual figure since national records began in 1899. The economic consequence is straightforward. Fewer workers produce less output, generate less tax revenue, and service more elderly dependents. The denominator in the debt-to-GDP ratio, the GDP, grows more slowly. The numerator, debt, continues accumulating through social welfare obligations to an aging population. The ratio worsens mechanically, even if no new debt is issued. The second factor is the global context in which Japan is operating. Japan is not alone in carrying excessive debt. The United States, the United Kingdom, France, Italy. Every major developed economy is running significant fiscal deficits and competing for the same pool of global bond buyers. This matters because the absorption capacity of global capital markets is not unlimited. When every major government is simultaneously issuing debt and one of the largest historical buyers of that debt, Japan, begins stepping back, the supply and demand dynamic in global bond markets shifts structurally. The era of abundant, cheap capital flowing from surplus nations into deficit nations is ending. Japan was one of the primary engines of that flow. As it reverses, the cost of borrowing rises globally, not just in Japan. 3 scenarios for how this plays out. I want to be clear that I do not know how this resolves. No one does. But I can describe 3 plausible trajectories, ordered by what I assess as their likelihood. Scenario 1, the gradual adjustment. The Bank of Japan moves slowly and deliberately. They raise rates incrementally over several years. Japanese institutions reduce their foreign holdings gradually rather than abruptly. Global bond markets absorb the selling without acute disruption. The yen carry trade unwinds over a decade rather than a quarter. Americans experience modestly higher borrowing costs and a somewhat weaker dollar, uncomfortable but manageable. This is the most probable scenario, primarily because it is the outcome that all major institutional actors are incentivized to produce. Scenario 2, the disorderly unwind. Japanese bond yields move faster than anticipated, to 4 or 5% on the 30-year, driven by some combination of accelerating inflation, a geopolitical shock, or a loss of confidence in the Bank of Japan's capacity to manage the transition. Institutional investors facing rapid deterioration of their carry trade positions sell U.S. Treasuries not gradually but urgently. Selling triggers more selling as algorithmic strategies respond to yield movements. U.S. Treasury yields spike, mortgage rates follow. Equity valuations reprice. The April 2025 episode, a $20 billion sell-off in weeks, is a small preview of what a disorderly unwind at scale looks like. Scenario 3, systemic crisis. Debt servicing costs exceed Japan's fiscal capacity. The Bank of Japan is forced to monetize debt at an accelerating pace. The yen collapses. Japan's financial system experiences a destabilizing crisis that propagates through global counterparty networks. This is the scenario that looks like historical currency crises, and it is, in my assessment, the least likely, primarily because Japan retains meaningful institutional tools and credibility that most countries that have experienced such crises did not. My base case is Scenario 1, with Scenario 2 as a meaningful tail risk that warrants serious attention. What I want you to understand from this is not that disaster is imminent. It may not be. Japan has been managing this imbalance for 30 years with more skill than most observers would have predicted, and I have respect for that track record. What I want you to understand is that a structural shift is underway in global capital markets, and that shift has direct implications for the cost of borrowing, the value of assets, and the purchasing power of the dollar. These are not abstract macroeconomic variables. They are the inputs that determine your mortgage payment, your retirement account balance, and the real value of your savings. The principles I return to in environments like this: understand your actual exposure. Know what you own and why you own it. Ensure your financial structure is resilient to scenarios where rates are higher for longer than expected. Do not carry more illiquidity or more leverage than you can sustain through a period of elevated volatility. The era of cheap global capital, subsidized for decades by surplus nations recycling their savings into U.S. debt, is in the process of ending. That transition will create winners and losers. The difference between the two will largely come down to who understood the mechanism and positioned accordingly. Now you understand the mechanism,